right. Well, what is up, guys? It is Financial Friday! Yes! Financial Friday once again, and I am Dan Farnsworth. I am a retired naval officer, now owner and founder of Victory X Financial, where we build wealth for those who serve. We are now online at victoryxfinancial.com. Yes, we have launched our new website. We are officially in the ether. So go check us out, victoryxfinancial.com. My calendar is there. You can get on my calendar. You can book appointments. You can check out and see what we do. Lots of really good stuff coming our way. We got some really big plans as we go into the fall season. So anyway, this week we're continuing with our Retire Max Elite program, which is again a program that serves veterans and veteran business owners. All right, and this week we're talking about infinite banking. Okay, what is infinite banking? You might have heard that term floating around the internet somewhere. Well, the infinite banking concept goes all the way back to the 1970s. It was really kind of coined by an insurance agent named Nelson Nash, who sadly we lost him recently. He passed away at a very old age. But Nelson had written a book back in the 1990s called Becoming Your Own Banker, the infinite banking concept. And it basically talks about how we use life insurance products to be able to build wealth. Okay, and to be able to recapture our debt and turn that debt into wealth building vehicles. Okay, so let's go ahead and talk about a scenario that we will be referencing the Retire Max Elite program and how we would use the infinite banking concept in this type of program. So today we're going to be looking at a case of a U.S. Air Force Master Sergeant. He's E7 in the Air Force, right? Master Sergeant. He's 40 years old. He's been on active duty now for 20 years. He's planned to retire in 3 years. Okay, and his life expectancy in this scenario is going to be 92. Okay, now his current gross income, because again, he's not retired yet, so he's still got income, right? His current gross income, including his allowances and everything, is about 95, almost 96,000. Okay, we're going to say he doesn't have any money in TSP, but he personally has savings of about $15,000. We'll call it 15 on the spot. So he's got 15,000 in a savings account, let's say. Okay, he's also got some credit card debt. Okay, his credit card debt currently is about 25,000, and he's got a vehicle loan for 30,000. Okay, now because he's not retired, we're not worried about SBP or VGLI. We're just going to jump right into the infinite banking comparison. Now, if he were to start an IUL, which is part of our Retire Max Elite strategy, we use IULs because I believe it's a superior product for building tax-free retirement income. So we're gonna take in this scenario a monthly contribution of $500. Okay, so $500 in this case is really only about 5% of his income. So that's a pretty moderate amount. But considering he's got these other payments, he's paying on the credit cards, he's paying on the car loan, we're just going to start this at a moderate rate, and we'll kind of build up from there, okay? So $6,000 a year. He's also going to dump in the $15,000 that he's got in savings, okay? So that first year, we're going to put in the $15,000, and then we're going to continue on with the $6,000 a year, and we're going to fund this policy all the way up until age 65. All right, so with that being the case, the overall total personal contribution, $165,000. That's what he's putting in over the course of 25 years that he would have otherwise just been saving or hopefully not spending. But, we'll call that savings, right? So his starting death benefit is going to be at $258,000. Okay, and then what we're going to do is we're going to just take a look right now and see what does that look like if we didn't take any policy loans and we didn't use infinite banking. Okay, so we're using one of our other carriers to illustrate this because they allow us to illustrate loans earlier on in the policy. But just know that we can kind of do this with any of the carriers that we use, and we would optimize that depending on the situation. Okay, so here we see the policy as laid out with no loans taken in any years. We're just gonna go straight for retirement income. Okay, so we put in our $15,000 the first year. We see we've got a surrender value of about $9,700. Okay, so we could take out a loan up to right around $9,000. But then we continue on down the line with $6,000 a year up until age 65, where we start drawing income to the tune of $38,500. $544 per year, tax-free for life. Okay. Now, in this case, in this scenario, our death benefit peaks at age 65 at $590,000. Okay, it starts to go down because obviously we're drawing against the policy. We're drawing against the death benefit at that point. This is all tax-free income. Okay, so we see we're going to continue to take $38,500 a year, tax-free every year all the way up until 92, and then that's the end of the life. And at the end of life, we see we're at 123, just almost 124,000 in death benefit. Okay, so we saw we had a total of 153,000 in. We took a total of just over 1 million, 1,040,000 in income. Okay, so already we took 153,000 and turned it into over 1 million in this scenario. All right, now we've got, and we added in the death benefit, which was, we said 123.7. Okay, so let's take a look and see what it looks like if we do the infinite banking, if we apply infinite banking in this scenario. Okay, so again, we're not adding any additional money to this. All we're doing is we're taking, remember we said he's got this debt, right? He's got 25,000 in credit cards, 30,000 in vehicle loans. So all we're going to do is we're just going to kind of strategically work in the debt into the policy. Okay, and what does that look like? Well, let's look over at this scenario version 2. Okay, so again, we said we're going to dump in 15,000 first year. We're going to do 6,000 a year thereafter. But look what we did here. We know that we had 15,000 in cash value after the second year, right? So what did we do? We took a $10,000 loan in the third year. At the beginning, the first day of the third year, we're going to take a $10,000 loan. Now, why not 15? Well, we could take 15, but we do want to play it safe, okay? We do want to make sure that we're leaving a little bit in there just in case we got to cover the interest, in case we, for whatever reason, don't get a spread that year. Now, I will say these indexes have been performing extremely well, okay? And if there's one thing that IUL has really, really improved on ever since its inception in 1997, is the index strategies. Okay, we've got indexes right now that, I kid you not, are performing at roughly 19 to 21%. Okay, these illustrations only illustrate at 6.4. Okay, and that's regulated by SEC. Okay, they're going to regulate it as to what the carriers can illustrate at. Okay, but realistically, the S&P has been performing at roughly 9% over the course of the last 30 years. Okay, so just know these numbers are going to be on the low side when we're looking at the actual cash values and death benefit values of the policies. All right, so that being said, we're going to take a $10,000 loan because we're going to play it safe. We're going to leave a little bit of cash value in there just in case we need it for emergencies or just in case we need it to cover any loss of arbitrage. And we're going to start repaying that loan. Now, we went and we calculated for this loan, we said we're going to repay it over the course of 5 years. Okay, so policy loan number 1 in year 3, $10,000, we're going to charge ourselves 7%. Why 7? Because we're going to get a 2% spread. Carrier is going to charge us 5. We're going to charge ourselves 7, right? Because we're honest bankers and we want to make money. So we're going to repay that to the tune of $2,400 a year for 5 years. Okay, now in year 4, policy loan number 2, we're going to take out another $10,000, right? Now, what are we doing with this $10,000 and this $10,000? Well, we're paying it toward the debt. Okay, so we're paying off our own debt using this $10,000. All right, so now we've got two $10,000 loans out. Okay, and we're repaying them at the exact same pace at 7%, so $2,400 a year for 5 years. Okay, now in year 3, we're going to take out the remaining balance because we said we've got $25,000 in loans, so we're going to take out an additional $5,000. Now we've completely cleared out the credit card debt. Now chances are he's been making payments on it, so we may not need to take $25,000, but we're just kind of doing this in theory, okay? So we'll say maybe he's charged some stuff on it since then, okay? So he still had $25,000. So now we have paid off the $25,000 in debt. We have recouped it into our own bank, right? Because this is now our bank. We're putting it in our own bank, okay? So Now we're paying, you can see where we've added it on to the initial premium. So in the first year, we took the $10,000 loan, we added on the $2,400, so we went from $6,000 to $8,400. Then we did it again. We went from $8,400 to $10,800 because we added on the additional $2,400. Okay, then we added on, I think it was just over $1,200. So we added that on. We came out to an annual contribution of $12,026. Now what that's doing is it's basically just continuing to pay those loans. Okay, now could we reduce that after the 5th year from the first loan? Yeah, I mean we could. We could reduce it really at any point we want, but we're going to just keep paying that because we're used to paying that, okay, over the course of the next, we'll call it 2 years, right? We're just going to keep paying that into the policy because at the end we want to continue to build up our values, right? We want to continue to build up our cash. So now in year 8, we're going to take a vehicle loan. We're going to take $30,000, right? We see we've got $37,000 in cash value, so we're going to take a $30,000 loan. Now he could go out and buy a new vehicle if his current one is paid off, or if he still has outstanding, debt on the vehicle, he could pay the vehicle off at that point. But either way, we went and we calculated what does a $30,000 loan repaid over the course of 5 years at 7% cost. And the answer is it's about $609 a month or $7,316 a year. Okay, so we're going to do that now. We're going to add in this $609 a month payment into our policy. So that takes us from what we were paying at $12,000 now up to just over $19,000. But you can see after the 5th year from when we took this $5,000 loan, we're now going to stop repaying those loans. Okay, so this little chunk of loans right here, we're going to stop repaying that. Okay, and we're going to go just now where we're just paying the $6,000 again. We're contributing $6,000 and we're paying the car loan, right? And what you can see here is that we are now doing this every 5 years, right? So we're going to take a $30,000 loan at year 8 and we're going to pay it back. We're going to take a $30,000 loan at year 13 and we're going to pay it back. $30,000 at year 18, pay it back. $30,000 at year 23, so he's now 63 years old. Now what we're going to do is we're going to pay it back, but once we get to 65, we're going to start drawing income, which means we're no longer contributing the $6,000 a year that we were before. But we still want to repay the car loan, right? So we're still going to keep paying the annual car loan until the car is paid off, right? And you can see here that if we do that, what have we effectively done to our cash value? We have gone from $38,544 to $48,345. So we have effectively added $10,000 a year onto our tax-free income simply by moving the debt into the policy and using infinite banking. Right? It's as simple as that. We haven't contributed any additional money into this policy. All we did was we just took the existing debt that we were already paying on, we moved it into the policy, and then we continued to fund our debts out of the policy for up until age 65, and we literally increased our annual income by $10,000 a year. Now, could we continue to do that up until age 92? Absolutely. We could keep going with this. We stopped illustrating this at the 68-year mark once that last car was paid off. We could just keep going and going as long as we have mech space in this policy. And oh, by the way, if there's loans on the policy, you've got mech space. You can keep doing this. You can just keep on rolling. Okay. Now look what it also did to our death benefit. Right? When we start drawing income here, we finally stop funding the policy. We pay off that last car loan. We're at $594. Okay, it's going to peak at $642, which means when we get all the way down here to age 92, where are we at? We're at $219 now, right? Where were we before? We were at $123. Now we're at $219. Okay, again, we didn't contribute any additional money. All we did was we took the money that we were already paying to the bank and we put it back in our own bank. This is how banks get rich, okay? It's how you can make money too and get rich too, okay? So let's go jump back over to our scenario. So we said that in this situation, in this scenario, in the infinite banking with the loans, our total income we said was 1.45 million. Okay, over the course of our lifetime, all tax-free. So we have to add in a 25% estimated tax savings, brings us up to 1.8 million. Okay, death benefit was 219, which brings us to a grand total of 2,032,295. And you compare that with the other scenario only gave us 1.1 million. So we literally doubled the value of our investment, right? We can't really call it investment because it is insurance, right? But we doubled the value of our private pension plan, right? Just simply by using the infinite banking concept. So, guys, if you have any questions about this, feel free to reach on out. Again, over at victoryxfinancial.com, you guys can get on my calendar. We can talk about this stuff. We can illustrate this stuff. And again, even if we don't end up doing business, I'm happy to help out our veterans, our first responders, because that's what we do. We help patriots in this country to win the chess game against the IRS. Right? Taxes are the enemy in this case, and we are going to prevail. So again, I'm Dan Farnsworth. Appreciate you guys being here this week. Again, let me know if you guys have any questions, and we will see you in the next video.